Welcome traders. Today we're going to be trading PMI data and I'll be focusing on gold. Now my expectations for this is if PMI data comes out above expected, I'm going to be looking for gold downside, so gold sells. But if PMI data comes out below expected, I'll be looking for gold buys or gold upside. The reason I'll be looking for this is because gold has an inverse correlation to the US dollar, and I'm expecting PMI data to impact the US dollar, right? PMI data is just a measurement or an index that tells us the strength or weakness of an economy. Now, if PMI data comes out above expected, this tells us that we have a stronger economy. The reason I would expect this to give dollar strength and gold downside is because this means the markets might start expecting the Federal Reserve to pause interest rates, because when you have a stronger economy, they don't want to cut rates. Right now, the markets are expecting rate cuts. This will give us dollar strength, gold weakness, at least in the short term. So if we see that come out higher, I'm looking for gold sells. And the inverse is true. If we see a weakening economy, meaning PMI coming out below expected, this is just more confirmation that the Feds can continue to cut rates. This is going to be weaker for the dollar, which is why I would continue to look for gold buys. Now that the data has actually come out, let's take a look at gold and the trades that I took. This right here is my economic calendar. You can see the PMI data that came out. Now, if we take a look at the time that it came out, you can see it says 9:45 a.m. I'm in the Eastern time zone, so this is an Eastern time. The data came out at 9:45 a.m. Now, if we take a look on gold, where it is right here, and we take a look at the bottom, you can see this is also at 9:45. So that's the first thing to take note of. We can also see that the data, the expectations is we have 55 and we have 47. Now, if we take a look at this little surprise box, this shows us the difference between the expectations and the actual, right? So where this says 0.3, this is telling me that the data came out 0.3 above expected. So this data came out higher than expected. Now, if we take a look at what I talked about earlier, this little cheat sheet here that I made, this is what I do for my analysis. If data comes out higher, I'm looking for gold to drop lower, right? So I want to see gold sells. Now, the second thing I would say is I was also looking for dollar strength. And again, the reason I'm watching dollar is because there's an inverse correlation between the dollar and gold. If dollar pushes up, I'm looking for gold to push down. If dollar pushes down, I'm looking for gold to push up. So this is just called intermarket analysis. I want these things to be in line in order to take my trades. The data came out at 9:45, and we can see that DXY, the dollar index, was just kind of consolidating here. Now, when the data actually came out, if we take a look at what the dollar did, we had that reaction, right? So dollar immediately spiked to the upside, and this is why I was expecting gold to break this support that we have here and start pushing lower. So if we take a look at how gold reacted, we had the first candle immediately breaks lower, and then if we played the next one, we immediately hit. This is where I ended up taking profit, right? The next support area. So the entry was up here, breaking the support, following dollar strength, following the PMI data, and then just taking it to the next support area. So I'm still using my technical analysis to take the trade, but here's the difference. I entered this trade before the candle closed, right? And I'll actually show you the entry. I have it right here, just for proof, if you want to see it. This is the entry. You can see the time, 9:46 a.m. I posted this inside of my live trading group. And this is the trade that I was in, right? You can see what my entry is. You can see that I went break even and all that fun stuff. Now, I entered this trade here before it actually broke resistance. If you were not paying attention to this data and you don't know what's happening here and you tried doing that, how many losses are you going to take on gold? Because you'd enter here, you'd enter here, you'd enter here, and you would just keep trying to enter sells with no reasons. But I had reasons for dollar strength and I had reasons for gold to drop. And I waited for that to actually happen. So when you take a look at this trade, you're looking at a 70 to 80 pip move in a matter of 3 to 4 minutes. And I have high probabilities to take this trade. Again, if you take a look at the times here, we can see that the data came out at 9:45 a.m. Eastern. And if you look at the time at the bottom of this chart right now, 9:50, take profit for 80 pips on gold was already hit. 9:45 when the data came out, it broke. 9:50, the next candle came down, and then we take profit here. This is how you reduce the risk of losing so many trades, because you're actually using data with reasons behind the trades that you take. If you're trading anything and you're not understanding or paying attention to this data that's coming out every day or every week or even every month, what are you looking at, right? Are you just looking at candlesticks moving up and you're just looking at random trend lines or fibs or all these indicators that these things react to the moves of the markets after the fact, right? So if you take a look at data and you understand how to trade the data, just like I showed you, I had expectations of what's going to happen to gold before the data even came out, because I understand how the data is going to impact gold. Trading and showing up to the charts every single day is like a test. And you're not going to pass your test if you show up without any of the information that you need. This is why preparing for the test or preparing for trading is important. You don't want to go unprepared because most likely you're going to fail. So here are 3 things that you should watch if you trade gold. The first one is the US dollar. There's an inverse correlation to the US dollar and gold, which means when the dollar drops, gold will typically move up. Or when the dollar gains strength, gold will go down or be pressured to the downside. This is most of the times, but it's not 100% because there are other factors in the markets that can impact gold or the US dollar. So when you're trading, make sure you're paying attention to the US dollar. The second thing would be geopolitical tensions. Gold is looked at as a safe haven asset, which means investors typically like to pool their money into gold when there's market fear. Market fear would be things like geopolitical tensions, it would be things like war, stuff like this. So when you see a war coming out, pretty good chance that you'd be looking for gold to go higher. And the third one would be inflation expectations. Gold has a very strong correlation to inflation expectations. What this means is that as inflation goes higher, gold typically goes higher. I'm sure you've heard before that gold is a hedge against inflation. So when inflation goes up, gold typically goes up. Once again, this is because investors like to pull their money into something that's a safe store of value, which would be gold. It's a physical, real, tangible asset. And when inflation is high or increasing, where do investors want to put their money? A commodity like gold. If you guys like this video and you want me to do more trade breakdowns or even something that you trade specifically, whether it's NASDAQ, US 30, US dollar pairs, anything, just let me know in the comments below and I'll consider it for the next video. I'll see you guys there.